Hey everybody, hope this video finds you great, hope it finds you well. As you guys know, I am on vacation, but I still wanted to get a video out to you guys. I've been slacking in that respect, probably because I was getting ready for vacation, needed to finish up a couple things at work, but there's really no excuse other than the fact that I never got a video out. So this video, and I might do another one later because I'm feeling pretty energized, is specifically going to be talking about my Fundrise account and specifically more than that, what I'm doing and using it for. So at the moment you see is around $1,700 or so. This is actually going to be updated tomorrow, but I'm too lazy to wait until tomorrow. And the reason why $137 is being added is because I took a test. There was a feature on Fundrise that said, you know, how quickly do you want to reach a milestone within your portfolio within Fundrise? And I said, you know, $100,000 would be nice. So with that, they said, well, if you do $137 over however many years, you'll get to $100,000 portfolio. I wanted to say it was within 10 or 20 years. I don't really remember per se. But what I was taking that as is I'm going to utilize it as an ability to diversify a little bit of the portfolio, get it out of the stock market a little bit. Obviously, I still enjoy the stock market. It's where the majority of my wealth is. But I'm trying to diversify, get a little bit out of, say, specifically stocks and into more physical real estate. And while I invest in real estate investment trusts that are physical real estate, this seems a little bit closer upstream to the actual investments of physical brick and mortar, I guess you could call real estate. So, anyway, with respect to that, there's about $1,700 in the portfolio. You can see that all-time gains and dividends and appreciation, not too much. It's only $170, almost $180 or so. But you can see the majority of the time, I was basically just nursing this $1,000 increase here. And you can see this is either through dividends or appreciation. And then more recently, once I took that feature within here, I started adding about $137 a month or so. So this should end up getting close to about $1,860, $1,870 by tomorrow, but because today it's going to be investing $137, but I was just too lazy to wait. So with respect to what is actually going on within the portfolio, what's actually being invested in is, if I scroll all the way down, and it'll eventually let me show you guys this entire chart here, or maybe it won't. But anyway, on the right hand side, you can kind of see what is split up into the portfolio. It's about 62% equity, 38% debt, meaning that 62% equity, meaning specifically investing into physical real estate, whereas 38% being debt, meaning we're basically owners of the mortgage and people are paying us a steady stream of income. What I don't have in here is any A-class properties, which is pretty disappointing. But I guess with the fact that I'm trying to aim for supplemental income, it makes a little bit more sense. A-class properties, they might be more so looking towards capital appreciation. But I think the way that I selected my portfolio, supplemental income, it's aiming more towards dividend payouts. As you can see, I think it was like 3/4 of which of my returns have been through dividends and only 1/4 have been through appreciation. So anyway, that's that aspect of things. But you can kind of see what exactly I've invested in. The year-to-date performance has been about 4.9%. Reason being is I think there's some funds that are recently ramping up and thus do not have a lot of return so far. What I have been surprised about is you still have this income E-REIT here that is only ramping up, but it's still returned about 6.6 to date. This has grown about 8% to date, the growth E-REIT, which is pretty surprising. I don't want to necessarily go into any of these. The East Coast REIT been 8% as well. So this is pretty surprising. It's being offset partially by this Washington, D.C. E-REIT, this LA E-REIT, and the National E-Fund E-REIT. And the reason why is, I mean, that's a pretty steep drop up if you ask me. But let's just look at 2019 to date. So and ends up offsetting a good bit down to 4.9%. But the reason being is, and I saw this a little bit earlier, I thought it was quite surprising, but also not too surprising, just based off the fact that there's a lot of ramping up going on in these Washington and LA REITs, is I pulled this map up. And I knew that this was the case, but I guess I was still slightly surprised that everything is so drastically driven towards LA and Washington, D.C. So if you just zoom in, it's not like the whole California seaboard or anything like that. It's all focused on basically the Beverly Hills, West Hollywood, LA area. And then you do have a little bit down here in what looks like to be San Diego, I think, towards Long Beach and everything like that. But I think that's San Diego. I don't know. I'm not very good with... That is not San Diego. That is apparently just Long Beach. So, I'm not very good with my California geography, so please don't bash me there, because I'm an East Coast boy. But anyway, you can see there's some Midwest things in here towards Texas as well. I was surprised I didn't really have any properties in Houston, my old stomping grounds. But they do have a little bit as well in Georgia area, I guess towards Atlanta, which I was pretty impressed by as well. Maybe that's not Atlanta. I don't really know where Atlanta is, to be 100% honest with you. But they did also have a couple properties in New York, only one or two, and the majority of the remainder of the properties are showing up in the D.C., North Virginia area, which doesn't surprise me, right? I mean, it's called an LA E-fund and also Washington, D.C. E-fund. But I was just relatively surprised at the amount highly concentrating in there. So you have like 89 properties towards LA, 39 in DC. You have a lot in Georgia and Florida as well, but everywhere else it's very sparsely populated. And I also checked across the globe. They don't have anything else across the globe. So I'll just show you guys here. It's all concentrated within the continental U.S. at the moment, which I think is interesting. You could potentially see in the future, maybe, I don't know, an ability to increase exposure outside of the United States, which should be interesting as well. But anyway, just wanted to give you guys a quick update about the Fundrise portfolio. Nothing too crazy going on, but like I said, still adding $137 every single month, hoping to increase this to a sizable portion that it's actually showing up in my pie graphs. If you guys remember my numbers portfolio that I show you guys with the overview with respect to income and with respect to value, this barely shows up because at the moment I believe it is less than 0.5% of a portion of the portfolio. So the portfolio itself is around 350 or so thousand, of which 250, 260 is dividend income, or just outside of my 401k, so I can actually track it. So this definitely shows up as less than 1%, and in the whole grand scheme of the portfolio, being over $360,000 at this point, it's less than 1% or less than 0.5% in actuality. So anyway, that's really it. Nothing too crazy. Like I said, it should be growing from 1,700 to about 1,860 tomorrow. Just wanted to get this video out for you guys and see if it sparks any interest. But I think the thing that was very most crazy for me to see today was that map of the U.S. and where everything is concentrating in these E-REITs and these investments here, because they're obviously concentrating very heavily into the LA, DC area. But the thing that also kind of got me confused was, I mean, yes, while those are, decent portion of the portfolio, in terms of percentages, I have a lot of percentages in income growth, East Coast, Heartland, West Coast. And so while it does say West Coast, it's not really doing up the entire West Coast seaboard, like from Seattle all the way to San Diego. When it's saying East Coast, it's not really doing that either. It's not going all the way from Maine to Florida. It's concentrating in Florida and maybe a little bit of Georgia and also a little bit of DC. And then you obviously have the DC and LA funds themselves. But yeah, it's pretty interesting. I would have figured with a national fund and and other income funds that it might have spread around the U.S. a little bit more, because I know there's some smaller Midwest places that people target at the moment for single-family home residences that are very cheap to buy but have very decent rental income, over 1% of the value of the home per month in some of these places like Tennessee and outside of places in Georgia and whatnot. So just very surprised that we're aiming towards low cap rate areas like Washington, D.C., L.A., and New York. Georgia, maybe less so of a low cap rate area, but still not one of the massive growth markets like we're seeing in some of these Midwest areas. But anyway, just my opinion, and I will see you guys on the next video. Cheers.